Alright guys, so in my last video we talked about Bitcoin mining versus Bitcoin ETFs and how Bitcoin ETFs were a scam. Also in that video we talked about two Bitcoin mining companies that are the top companies in the USA that I feel are safe to invest in. Now if you haven't watched that video yet, that is something to watch after this video, so make sure to do that. But today we're going to talk about three Bitcoin mining ETFs that invest in those two Bitcoin mining companies that I was talking about that I feel are low risk but high reward potential. Remember guys, this is not financial advice. So first on the list is Schwab Crypto Thematic ETF. It is issued by Charles Schwab, which started on August 4th, 2022. Now it has an expense ratio of 0.30%. Dividend is 0.93% with a PE ratio of 9.35. Their top holdings include Marathon Digital at 10%, Coinbase Global at 9%, Riot at 9%, and MicroStrategy at 8%. Now, need I not remind you that all of these companies that I'm gonna mention are really new. But they're also companies in which I think they have a low chance of failing because Schwab is one of those too big to fail guys. And this ETF, the year-to-date return for this has been 73.54%. Then again, if we look at the 1-year price chart, they're basically trading near the all-time high. So this one is something that I can wait on. Alright guys, another thing that I want you to note is that all of the ETFs that I'm recommending today are low risk by crypto terms because they're all backed by too big to fail companies. Another thing that I really want to hit home that I didn't take too seriously when I was younger is to be mindful of expense ratios. A high expense ratio is somewhere between 0.3 to 0.4. Even higher, you're not even going to think about it. And I'm currently reading a book called The Bogle Effect, which really is a biography of John Bogle, the founder of Vanguard, and he noted the same thing, that between 0.3 to 0.4 and higher, that's a really high expense ratio. To really hit this home with real numbers, if you put in $10,000 into a fund with a 0.3% expense ratio, you're paying $30 a year. Now that seems like not much, right? But let's change that number to $1 million. $1 million at 0.3% is $3,000 per year. While STCE is a 0.3% expense ratio, it is pretty expensive. But you know, being an actively managed fund, it might be worth it, and I am using might as a very loose word. Now coming in at number 2, we have Fidelity Crypto Industry and Digital Payments ETF, FDIG. Now this one does track an index, but they have an expense ratio of 0.39%. They also have a PE ratio of 7.27. And unfortunately for us, this one does not pay a dividend, which really sucks. Their top holdings include Coinbase at 18%. That's an incredible portion of their portfolio. Marathon Digital comes in as second best with 13%, Riot at 10%, and Hut 8 at 5%. So all three of these companies are actually mining companies. So although they have much of the same companies as STCE, which we just saw, I'm not a big fan of this one just because of their weightings. This is a very unbalanced portfolio. It's not very well diversified. What particularly scares me is that basically almost 1/5 of their portfolio is in Coinbase. This ETF started in April 19th of 2022, so it's rather new. But their year-to-date return is much better, coming in at 128% for year-to-date. But you can't just base your decisions off that. You also have to look at the price charts. And when it comes to the price, if we take a look at the 1 year, they're basically trading near their all-time highs as well. Their all-time highs being around $26, so just $3 off. So if you're looking to get into this one, which I wouldn't recommend, then I would also just wait on it. So I also don't like the fact that it doesn't pay dividends. Now, when I was younger, I wouldn't have mind of a company, a growth company, not paying dividend. But now with age comes wisdom, and I realize how important cash flow is. To really bring this home, imagine you own a house, right? But you don't rent any part of the house to anybody. So what you're doing is you're just putting money in without getting money out. And unlike other people, I don't like counting on appreciation to get my money, because in order to get that appreciation, you either have to sell the house or you have to put your house up as collateral. So in the same sense, you could think about it as when an ETF actually pays dividends, it's basically passive income, right? You can still own the asset, own the ETF, and at the same time, you're getting paid without having to sell the ETF or without having to put it up as collateral. So number 3 on the list, we have iShares Blockchain and Tech ETF. IBLC. Now this one also tracks an index, but they have an expense ratio of 0.7%. When I was talking about expense ratios that are too expensive, this one is too expensive. But also at the same time, their issuer is BlackRock, which is the biggest institutional investor in the world. When we're talking about too big to fail, if these guys fail, then the whole world is going to hell in a handbasket. Despite its high expense ratio, this one has a very low PE ratio coming in at 6.16. And this one actually does pay a pretty high dividend at 1.17%, which is the highest on our list so far. Their top holdings is much more diversified than what we saw with Fidelity, with Riot Platforms holding 14% of the portfolio, Coinbase another 14%, Block, which is Jack Dorsey's payment company, at 11%, which is not crypto, which is good because we're going to get some dividend from these guys. And Marathon Digital Holdings, which is coming in at, let's just say 6%. So personally, I really see this as similar to the other 2 ETFs that we saw, but this one is a lot more well balanced. And let me remind you guys that Block is one of those companies like MicroStrategy that does hold Bitcoin in its treasury because they don't trust the US dollar like most of us don't. Now, taking a look at its performance, which we don't have much to look at, the year-to-date return is 136.77%, so it's really high, but mind you, they've basically been in operation for just a little bit over a year. And we can't really finish this off without taking a look at the price charts. And if we take a look at the 1 year, we can also see that this is also trading near its all-time highs like we saw with the other 2. So if you're really itching and you really want it, then I would say to just dollar cost average into this. So I don't think I can do you guys justice without comparing all these 3 ETFs side by side. So let's take a look at this chart where I compare the PE expense ratio, the dividends, and the year-to-date returns. And you could see that based on the expense ratio, for example, STCE would be the best bet. But if we're taking a look at returns and dividends, then IBLC would be the best bet. But which one should you really pick? So this is how it's gonna work. You're gonna take the dividend rate, and then you're gonna minus that by the expense ratio. And once you've done that, you'll find out that IBLC comes out at the top at 0.7%. That is how much you're gonna get back by investing into IBLC with its current numbers that I just showed you. The worst would be FDIG, the Fidelity Fund, because you're coming in negative just because they do not pay dividends. Even the Schwab Fund is a better pick if we're going between the 2. But however, if you're gonna go with these 3 ETFs, make sure that you're always gonna be keeping an eye on that dividend yield to make sure that you're not losing more money than you make. So guys, throughout this whole entire video, we talked about the 2 biggest Bitcoin mining companies that all of these ETFs invest in, but we didn't name them. Now, if you want to know which ones they are, please be sure to watch my next video on Bitcoin mining versus Bitcoin ETF.